How's everybody doing today or this evening, depending on where you're at? Justin, how you feeling, man?
Feeling great, man. It's a great day. It's hot outside.
That it is.
But yeah, my week's going well.
Good to hear, brother. Well, let's go ahead and get things started. We got a good sized group here. I'm sure we'll have a few more funnel in. I'll send out a note to everybody, let them know the meeting started. But we wanted to So first of all, everyone, welcome to the Indianapolis Multifamily Investing Meetup, the not so local meetup anymore. As over the past year, we've had folks from all over the country in, both to speak and to visit and to come network. And today will be just like that. We've got a special guest, Justin Gooden here. Justin is a longtime expert underwriter, and he has now moved into doing deals on his own in large multifamily. So excited to hear from Justin. He's going to talk with us about some underwriting best practices, how banks look at deals, and just a general wealth of knowledge to share. And these are always pretty open as far as question and answer. So if you have questions along the way, please go ahead and ask. And usually these diverge into a pretty good, back and forth combo. So I'm really excited to have you here, Justin. Why don't you go ahead and introduce yourself to the group, and we can go ahead and get rolling. And then after Justin presents, folks want to hold on. We always have a little networking session where you can talk about what you're doing. I love hearing what other people are doing out there. I can share some of what I have going on, and then making sure that we're hitting on our needs, our kind of haves and our wants, right? So if you've got something, you got a deal, you're looking for partners, you're looking for a buyer, you're looking for a seller, or you need contacts, brokers, insurance folks, any and all in between. We're all here to help. And we've had some really cool things happen in this meetup where we've had people partner up on deals. We've had people sell to each other. We've had people in the group broker for that same sale. So if you don't get it out there, it's never going to happen. So I encourage everybody to share because we're all just about helping each other here. So with that, I will turn it over to Justin. Thank you, sir.
Thanks, Ken. Yeah, I mean, first of all, just thanks for giving me the opportunity to present. So I'm looking forward to speaking with everybody here and adding some value. I'll go ahead and share my screen if that's okay. Awesome. All right, well, thanks, guys. So a little about me. I am local to the Indianapolis area. I was born and raised on kind of like on the west side of Indianapolis, Indiana. Currently live in Avon now. I'm married and currently have, two dogs. So those are kind of like my kids, I guess. I don't have any kids yet, but those are kind of like my, my pride and joy in my spare time. So a little bit, about my background, and I'll get into like kind of like the topic of the night. I just wanted to give, a little perspective of who I am and what I got going on. So, a couple years ago, I started out, I made the mistake that I didn't go to college fresh out of high school. So I was actually working a pretty hard labor intensive job, like manual labor type job, which, I obviously did not like a lot. And this is a big turning point for me in my life. So this is the picture of some of the furnaces I used to work on. So we used to melt down metal and turn it into molten metal, and then a gas would hit it and it would turn into a powder, and that powder would be sprayed onto helicopter parts and airplane parts. So as you can imagine, it was hot, labor intensive. I saw a lot of people get hurt, and something clicked in my head. I knew I didn't want to do that job the rest of my life. And I saw the kind of people that were, working there for 30 plus years and, didn't have the sort of lifestyle that I was seeking. So I knew I wanted to make a change in my life, but at the time I really didn't know what it was going to be. So I guess you can say I started going down this road. I call it, Justin 2.0, I guess. So I joined the Army National Guard, started serving in the military. Shortly after that, I went to the Kelley School of Business, graduated with a finance degree and supply chain management degree. And then there was a time where I was, working full time at that job, serving part time in the military, and then also taking full-time classes at the Clay School of Business, sometimes more than full-time. So, I mean, as you can imagine, it was a pretty rough couple years during that time period, but, it for sure paid off in the end. And, like Kent mentioned, I do have experience working in the commercial banking industry as a multifamily underwriter. And recently, a couple years ago, when I started going down my real estate avenue, I founded a company called Next Level Equity. And so we're primarily focused on, doing multifamily syndications in major markets. We really like Indiana, Kentucky, and North Carolina. So that's a little bit about me. And how I got involved in real estate is, I was sort of, this is while I was in business school. I knew I wanted to supplement my income and look for some different ways to earn passive income. And, I started, day trading and swing trading. And I'm not sure if anybody has ever, done that, but it's definitely not passive income. It's really unpredictable. The stock market is really volatile. And I mean, just long story short, I didn't last too long swing trading and day trading. And, I was looking for something that was, a lot more stable. And I had the idea of real estate. And, my dad is probably the only entrepreneur in our family. And he bought a duplex when he was in his early 20s. I remember one thing he always told me was he wished he would have bought more. And so that was like one thing that kind of stuck in my head. And kind of like my mindset in the beginning was, only rich people invest in real estate. I don't have enough experience or credibility to invest in real estate. And I couldn't have been more wrong. But at the time, I wasn't aware of, multifamily investing. And so I kind of just, took some action, bought a single family house, and I still own that, that awesome house you see in front of me today. So that was kind of like my first stepping stone in the real estate. These are sort of some of the things I've been up to the past couple of years. Just last weekend, I was in Austin, Texas with a mentor of mine, a guy named David Tupin in Austin, Texas.
Drag me. I was
Top right
ecstatic
is
to go.
a guy named Mark Kinney who owns a company called
And I
Think
gave it my
Multifamily.
best. I wasn't great.
Mark has been.
Hey guys, if you're not presenting, would you mind hitting the mute button? We're
Because
getting a
I
lot of
love
feedback.
So Mark Kinney is one of my mentors in the past, and so yeah, that's a picture of us up top. And other than that, I mean, just been really active. The bottom left is a property that we were touring. This one actually comes with a free mural on the side. You can see that. But yeah, I mean, just some things I've been up to the past couple of years: touring properties, staying active, getting in front of brokers. And actually, 2 months ago, my team and I closed on a 236 unit in Jacksonville, North Carolina. It's a great value add strategy, and really excited to be a part of that deal. And I know we already know like the benefits of apartments. Everybody is in this group to learn more about apartment investing, but we probably already know that it's one of the most, one of the best investments you can make. But back to my single family house, I knew that the single family world was not really scalable. I didn't want to own 100 single family houses scattered around the city and have 100 different tenants in all these different locations. So I knew for me it made more sense to go into apartments and have more of that economies of scale, have more as we all know with apartments, the greater number of units we have, the operating expenses decrease per unit, the more operating units we have. So in the long run, just it made more sense with the economies of scale aspect to go for apartments. And with the recent pandemic, we know that apartments are extremely resilient to recessions, the pandemic. There's always going to be a need for affordable housing and housing in general. So even through times like that, people are still going to need a place to live. Leverage, this is something that some people don't always talk about, but banks love financing apartments. It is pretty amazing that you can go to a bank or like a lender, and they can finance 75%, sometimes 80% of the purchase price. If you think about that, that's huge, and that's one of the great things about real estate is that you can leverage the bank to come up with that and only come up possibly 25%. So, if I was going to go to a bank and ask them to leverage 75% of my stock purchases, they'd probably just laugh at me. And then cash flow. I mean, cash flow is probably like my favorite one out of these. Cash flow is just really important because it's going to allow you to live the life you want now, versus waiting until you're 55 or 60 years old and retire. My 401k doesn't provide me cash flow every month. It's so that's one of the main things about why I love real estate is just allows me to live the life I want. Some things that have helped me get to this point, and I'm definitely no expert, but I just like to share a couple of things that have helped me. Probably the biggest one is changing my mindset, and this goes back to when I bought that single family house, and that's kind of that was my first thought when I wanted to get into real estate. Is just okay, I'll go out and buy a single family house, or I'll flip a house. And before I really educated myself about what was possible, that's really all I knew. And so it's really just about taking action, realizing that you can do things that may seem impossible to other people. You can do that. And there's a couple of things in the chat right now. I'll check. Cash flow is king. Yeah, I definitely agree on that. Mentors, I kind of mentioned this on the last page, but mentors has been a huge game changer for me. We all know that multifamily is a team sport. And if you're going to, start from this, from scratch, like I did, and, not have a team around you, it's going to be really difficult to be successful in this industry. When you don't have somebody that has a track record, that has credibility that you can leverage. It's definitely not required to have a mentor, but it can be a game changer for most people to actually, have that team behind you when you're starting out in this. Networking has been, another game changer for me, just meeting as many people as possible, getting on phone calls, taking people out to lunch, joining meetups like this. I like to say you never know where one phone call or where one lunch is going to take you. So, constantly networking is really key. Having a thought leadership platform. I mean, this could be, obviously a Facebook group, a podcast, but just something to, stay top of mind to people. And this could be investors, brokers, other syndicators. Just let people know that you're active and that you're serious. Having a podcast could really, help you stand out and show people that you're serious in this industry. And just education. So, I mean, you can, buy books on Amazon for $5, $10. You can listen to podcasts that are free. You can get on YouTube. So bigger pockets. I mean, there's just an abundance of information out there for free. And those are some things that kind of helped me out when I was getting started. Success leaves clues. This is one of my favorite quotes. And, basically just saying, take notes from more successful people, see what they're doing, see what works, and then do what those people are doing. So, a lot of successful people have mentors, have podcasts, have meetup groups. So just take notes from people that are already doing the things you want to do, and, look to kind of, not copy, but, look to do things that they're already doing. And now I'll just talk more about underwriting. I thought, talking about bridge loans in general might be a good topic. So this is kind of like what I have some experience in as a commercial multifamily underwriter. The lender that I was working at primarily focused on bridge loans. And is there anyone here that does not know what a bridge loan is? Or has never heard of one?
Looks like it's new to a couple people.
Some people don't. So yeah, a bridge loan is, just to sum it up, it's short-term temporary financing that, a lender that might require you to go get a financing loan like this if if the property doesn't qualify for permanent long-term financing. So, a reference I like to make is we all know about flipping homes and using hard money lenders. A bridge loan is just exactly that for a commercial property. It typically is a higher interest rate, short term, and your main goal is to get the property qualified for some longer term, better financing, and then get out of the bridge loan as quick as possible. Some typical terms that a bridge loan will, might offer, like I mentioned, short term between 1 and 3 years, IO or interest only. So meaning that you're just not paying any interest. I mean, you're not paying any principal on the property. It's only interest. And that can really help out your numbers and your returns on the property when you're only paying interest for the first 3 years. Recourse and non-recourse options. When it's non-recourse, meaning that you're not personally liable for the loan, it's definitely going to have a higher interest rate, but that's just to kind of mitigate the risk for the bank and for the lender when you're taking non-recourse. Like I mentioned, it could be it's most likely going to be higher rates than traditional financing, but that's because it's higher and it's more risk to the bank when you're taking out a bridge loan, so they need to mitigate that risk. And your rates can typically be fixed or floating. And can anyone guess, I guess, what would be the most favorable option on the lender side? Would it be a fixed or a floating rate? Floating, exactly. Yeah. So when the rate is floating, it mitigates the risk to the lender. If the market and the interest rates go up, then your rate goes up. So the interest rate risk to the bank is pretty much non-existent when it's a floating rate. Something that usually the borrowers do not want, but it's a more favorable side for the bank. And then typically you can find a loan to cost between 75 and 80%, and this is just all your costs associated with the purchase and the capex rolled into the loan. So why would a sponsor want a bridge loan? There could be a few different reasons. One being it's not stabilized and it's not hitting 90 for 90. And these are just some terms that you might hear in the industry. So I thought I'd, spell them out for you. But 90 for 90 means it's, occupied for 90 days or at least 90% occupancy for at least 90 days. So you'll hear the term 90 for 90. If it's not 90 for 90, then it's not going to qualify for a HUD or a Freddie loan, and you'll need a bridge loan. So kind of going off of that, it won't qualify. Maybe it's performing bad and the DSCR does not meet the requirements for better financing. Or maybe you just have a lot of CapEx in the project and you want to include all that in the loan. That could possibly help out your returns by seeking a bridge loan. And then the last one would just be, you're seeking a long-term permanent financing option. And I'll get into that in a second. So this is a property we acquired. I'm just kidding. We didn't acquire this property. This is kind of like what you typically think when you see a bridge loan is maybe, a property that's run down, needs a lot of work. And that can definitely be true. You can definitely see a lot of properties like this being acquired with bridge loans. And I mean, this property would only qualify for a bridge loan. But so this is a local sponsor we have in Indianapolis, Indiana, Spencer Gray with Gray Capital. Late last year, Spencer acquired the Villas on Fur, which is a 2018 year construction, 290 unit Class A community in Granger, Indiana. And that's northern Indiana, if you're not familiar with that. But as you can see, I mean, this is an extremely nice property, really new, in great shape. And Spencer Gray got a bridge loan for this property. So I kind of already mentioned this, but the reason why that he got a bridge loan for this property was because he was seeking permanent financing via HUD. And I'll kind of touch on this in a second also, but the HUD application process takes between 6 and 8 months to complete usually. So in order for him to go after that financing, Spencer would need to acquire the property today and start the HUD application process, after the acquisition. So the bridge loan allows them to acquire the property today and then do that. No seller is going to be like, okay, well, we'll get it under contract and then you can actually pay me in 6 months. So that's why Spencer Gray went for a bridge loan in this case for this property. And just to give a high level overview of what I just said, but I'm more of a visual person, so I thought this might be helpful. But kind of just what I just said, a bridge loan would be valuable because they can close on the property today with a bridge loan. If needed, they can complete CapEx, they can get it stabilized, and after all that is done, then they can start the HUD application process, which would then take another 6 to 8 months. And then when they're getting out of the bridge loan, they'll refinance out through HUD or a GSC, and that's Fannie or Freddie, and then that will pay off or take out the bridge loan, and then they'll be out into a lot more favorable financing terms. Does anybody have any questions about that?
I have one.
Sure.
This is Sean here. I'm based out of Indianapolis as well.
Hey, Sean.
What are some vendors that offer these bridge loans?
Some lenders. There's a local one called Merchants Capital. You can also reach out to other shops like Walker and Dunlap and Arbor. Arbor is, they do loans nationwide too. So those are some of the larger shops that come to mind.
All right, thank you.
Yeah. And then I'll get into really quickly, just like a high level overview of how, banks will typically, look at if you're, acquiring a property with a bridge loan, how they're going to look at that property. So it's just, these are all made up numbers, but typically, a bank is going to look at the historical financials of the property, and then they'll put it all side by side like this. And also, I'm not showing this, but there'll also be a column for the appraisal. The appraiser is always going to make a stabilized pro forma also, and then the bank or the lender will make a stabilized pro forma. So yeah, they do take in consideration, the historical financials and the appraisal, and then they make their own appraisal. I mean, they make their own pro forma. But for one example would be if the property is performing badly, maybe it's not stabilized, then they won't really look into the historical financials that much because it's not that important. A new owner is going to come in, complete capex, perform renovations, get the property stabilized, and hopefully run it a lot more efficiently. But this is kind of what they'll do. They'll put all these different scenarios up against one another, compare their pro forma to the appraiser, and ultimately they'll do a calculation below that NOI and see if that property is able to service the debt payment. That's really important because, like we were talking about earlier, the main goal for the borrower is to get out of the bridge loan. In order for them to get out of the bridge loan, the property has to hit a certain DSCR metric. So the bank is going to take a really hard look at their stabilized pro forma and see if it hits that DSCR, which will then qualify it to be taken out by a HUD or a GSE. And that's how the bank gets paid off. So they really want to be sure on that. So that's what a bank will typically do. And, they'll take into account the story of what's going on. They'll take a really hard look at the borrower and the team on the deal. They really like to see that the borrower has experience and maybe they've done a strategy like this before. They'll take a good look into the financials of the company, the guarantors on the loan, and credit scores. Those are all things they'll kind of take a look at and make a consideration if they want to do this loan or not. But ultimately, if they can get comfortable with the loan, agree with the strategy, and they think the borrowers can execute the strategy, then you should have no problem having a successful strategy on a bridge loan. And that concludes my presentation. I'm happy to answer any more questions. I do have a Facebook group that I'm really active in if anybody wanted to stay in touch with me. And I have a 7-day email course that's totally free. You can find out more about passively investing. But yeah, I'm happy to answer any questions, and thanks for allowing me to share.
Yeah, thanks, Justin. That was awesome. One question I have is, what are some of the downsides of going the bridge loan route versus some other options?
Probably the main difference is it's just going to be more expensive. You're with the bridge loan, it's more risk to the bank. And if you think about it like hard money, it's going to have a higher rate. It's going to have less favorable terms than you would get if you had like a Fannie or Freddie loan. But there are many situations like I spoke about there. It would be ideal to go over the bridge route, but probably just more expensive. It'd be the main concern.
Gotcha. And is there a scenario where so you're in the bridge loan, you know, you expect to be in it for 3 years. I mean, what's a scenario like what would happen where somebody wouldn't be able to get out of the bridge loan, right? And like what happens in that scenario?
Yeah, that's a great question. And that does happen from time to time. And on some deals, there can be what's called an extension, where the lender can, add an extension of a year or 2 years. They don't typically like to do that because when they made your loan, when they sized your loan, they're really counting on you to be taken out in 3 years. But yeah, to your question, there is something called an extension where the borrower could possibly extend the loan, and there's fees and other things involved in that. But that is one option.
Gotcha. Tell us about what's included in this free course you have. That's interesting.
Yeah, it's just a free course about how to get started passively investing. When you're kind of going down this route and you hear all of these, if you're totally new to this, you hear all these new terms and you're not familiar with it. It's just kind of like a really great course to kind of tell you A to Z how to get started. Here's the benefits, here's the risks, here's the action you need to take if you're interested in passively investing. So it's a totally free course. It'll send you an email once a day for 7 days. And just gives like a lot of great info.
Oh, right on, man. Sounds like a great resource for people that are looking to get started.
For sure.
I have a question.
Please,
sure,
Justin.
Hey, Justin. This is Justin. I think we might know each other. Do any banks do a bridge loan where they are actually going to be the entity on the refinance as well?
Yeah, that's a great question. There are some lenders that I guess are totally vertically integrated, where they can help you throughout the entire process. They can give you the bridge loan, and then you can go to the same lender to be taken out. They'll service the loan after you go to a GSE or HUD. So yeah, there are some lenders out there that are like, all in one place pretty much.
Interesting. Good to know. Any, do you have any names on those lenders?
Yeah, one's called Merchants Capital. They're here locally.
Sounds like you know a lot about them, huh? I'm not sure if I want to work with them. Do you have any other names?
All of this stuff.
Maybe Walker and Dunlap. I don't know. They might do that. I'm not sure.
Yeah, I'm not sure about that. So Justin, I saw there's a comment in the chat asking if you could give some examples of a bridge loan with numbers. Like, could you put some numbers to it, maybe?
Yeah, as far as like the numbers, a bridge loan, typically the more major lenders are going to want to see a loan amount of at least $3 million, I believe. And, like I mentioned, they'll usually give you a 75% to 80% loan to cost. And that's your purchase price. That's all your CapEx. So, if you wanted to go in and spend $5,000 a door on renovations and you needed $200,000 for the roof, so that would all be wrapped up in the loan, and they would give you between 75% and 80% loan to cost. But yeah, usually the bigger shops are going to like to see a loan amount of at least $3 million, I believe, just to make it like more worth their time. Hopefully that helps.
So maybe to kind of go along with that question, and maybe you've already answered a variation of this question, I was just kind of wondering, so why would somebody go with a bridge loan as opposed to maybe trying to find like a hard money lender? Is it more of the relationship? Is it kind of the size?
A bridge loan is pretty much a hard money lender for a commercial multifamily property. It's a higher rate. It's a shorter term. So it pretty much mimics a traditional hard money lender on the residential side. It's more just for commercial property. So I'd say it's really similar to a hard money loan.
Okay, yeah. So it's pretty much because I'm pretty new to this, and so so if we're looking for hard money and under, it would be this pretty much.
Exactly. Yeah. Exactly.
Yeah, I think the principles are similar, right? With why you would get a hard money lender or why you would get a bridge loan. It's because most likely it's a scenario where you're not able to get more conventional financing because the property's not stabilized or or something else is going on. That makes it, maybe the cash flow is not there, right? That makes it not fit the criteria, the thresholds to meet a normal like agency debt or even conventional bank financing. And outside of that, it would just be like you described, the HUD strategy is a pretty common strategy where you just need you need more time, but you need flexibility to be able to get in and out. I mean, that's what bridge loans are great for, is just the flexibility to be able to get out of it at any time and not be locked in with big prepayment penalties like you would be on some of the other loan types that are out there. And so like if you were going to do, if you had like a heavy rehab, for example, right, and you wanted to excuse me, maybe the property is even stabilized, but you don't want to lock into long-term debt right now because you're going to create a ton of value in the property, and you want to be able to get that value out of the property by refinancing. If you do like a Freddie small balance loan, for example, you don't have that option. Whereas if you do, or you're going to pay a lot of prepayment penalties if you do it early. As a bridge loan, you can easily get out and then go after an agency product for long-term debt financing. But after you've created a ton of value in the property, so therefore you can get a loan at a much higher value, and oftentimes you can get a good chunk of your initial investment back in doing that.
Exactly. Yeah. Thanks for saying that.
Hey guys, how are you doing?
Hey, great. Thanks for joining.
All right, my name is Lorenzo. I was the one like asking about the bridge loan with numbers. So what I don't understand about all of those hard money lenders and bridge loan lenders is like you always have to come up with at least 20 to 25% of the loan amount. This is the same requirement for any other loan. So why should someone come up with something like that when you can just go with conventional financing?
Well, the lender always wants to make sure that you have skin in the game, for one. And then you are correct. They could have similar leverage percentages to a conventional loan. The only problem is that it may not qualify for that conventional, like a Fannie or Freddie. So it does have to be, stabilized, has to be hitting a certain DSCR. And there are certain requirements with these different loan products that, may make the property not qualify for that product. Like we were looking at a deal recently and wanted to use a Freddie loan, but the parking lot was gravel. And this is news to me, but Freddie will not service an asset that has a gravel parking lot. It has to be paved, which was, news to me, but that might make sense to, use a bridge loan and then go to Freddie. So yeah, even if the leverage point is the same, it may not qualify for that product, or maybe the borrower just wants to do some sort of rehab and include that in the bridge loan.
And hey, Julie, saw you joined. We're digging into bridge loans, so right in your wheelhouse.
Oh, they're very popular right now.
Absolutely. No, Lorenzo, that was a really good question. I mean, the down payment requirements are largely the same. It's more about if your deal is going to meet the other qualifications for the different types of loans. Like Justin was talking about, if you're a stabilized property, for example, right? 90% occupancy for 90 days. If you're not, then those aren't going to be open to you.
All right, guys, thank you. And I'm new. Like I say, I am new. I don't really know a lot Everything that I know, I learned them from YouTube and books. So basically,
Yeah,
right now,
exactly.
I'm saving money. Like I don't have a lot of money, but I'm saving money. But I've seen in the past few days people talking about creative financing, like taking business credit card to fund deal. Do you guys have experience doing those things?
I personally do not.
That is a very high interest rate. You better have a good way in and a very sure exit plan to get out.
That's really hard money.
That's really that's the hardest
Yes.
money there is if you're going to use a credit card.
Yes. So I have like well, I have a friend. He got $155,000 in credit card, like between credit card ranging $30,000, $25,000. Like when he put everything together, it's like $155,000. He only pay 1% of the balance, like every month. So guess if you put something like that on a, I don't know, an apartment complex, like I know in Indiana or in the Midwest, they are not like that expensive. So let's say you put that on an apartment complex and you don't have a ton of things to do in the apartment complex. I think it can replace the bridge loan at some point because the requirements are really low. So one more question, the bridge loan, do you still have to provide tax return for it, or you can just go with what you have? Your credit score have to be good, but that's the only thing you have to do. Is it like the same requirement like as a conventional loan, or the bridge loan, they don't really care about your credit, they don't really care about anything, they just care about the deal?
At least in my experience, I know they still take a hard look at who they're lending money to. They take a really hard look at, the sponsor team, their experience, their track record, their credit scores, their financials. 'Cause, I mean, they really want to make sure that who they're lending to has the, you know, expertise, the capacity to, I mean, execute the business plan and get them paid off. So it is a lot more than just coming up with a 25% down payment or whatever it may be. So there is a lot of emphasis kind of put on the team and who they're lending money to. Would you agree, Kent?
I would definitely agree. I have not used bridge loans, but I know that I mean in any way, shape, or form, whether you're going with I mean, whether whoever you're getting debt from, I mean, they're going to look very closely at who the borrowers are, right? I mean, and one of the easiest ways to see just historical performance is looking just at that. I mean, looking at whether it's taxes or looking at your balance sheet, your net worth, right? Like all of those things come into consideration.
Definitely.
Hey,
Hey,
Justin, got a question for you.
Hey, Justin.
As a underwriter of a bunch of these bridge loans, what are some of the key things that stick out when going through the numbers that would potentially make or break whether the bank's willing to finance it, and what are some of the ways to kind of combat that? So, like, as an investor, I'm approaching the lender for a bridge loan. What are some of the items that definitely need to be squared away so I appear to be serious and able to be financed?
Yeah, that's a great question. So yeah, like looking from the bank's perspective, right?
Yeah. Yes.
Mostly what we just mentioned, but the team and the experience and the track record of who they're lending money to. I mean, that's a huge one. That's probably the main one that comes to mind. The credit score. There have been times where I have situations have come up where the credit score wasn't the best of some of the loan guarantors, and probably like a non-starter for a lot of banks or lenders will be if they have filed bankruptcy recently in the past, or if they have missed mortgage payments in the past, or, I mean, of course, like any defaults, that's a huge red flag. But one thing that kind of that I learned was, there is a little bit of consideration that we put into the credit score. For example, if the credit score was bad, maybe because of a serious medical condition, or they had trouble making payments, from some surgery or high cost medical thing, I actually learned that the bank won't typically, count that as a huge red flag, even though it did, affect your credit score. But it's more just a way to be, what's the word, like personable or, relatable, but you won't really ding them for, having like a serious medical condition if that affected their credit score. But if they see things like, defaults, or you miss payments on a mortgage, then that could be a huge red flag. Because if you're not going to pay your mortgage, I mean, it might say that you might not pay the loan. So, so yeah, definitely those couple of things, experience and track record of the team, and then, I mean, probably the deal. They get a lot of their information from the appraiser. So, if the borrower comes in and is, projecting super high rents that they want to go out and achieve, maybe the appraiser comes in below that and like, well, I don't think we can really achieve that high of rents. Then those are things that they might look into and take a second look at.
How does the mortgage, like forbearance and stuff with COVID, how does that play into, like, if an operator wasn't paying their mortgage during COVID, but then has, caught up, does that still negatively impact them?
You might know more about that than me. I'm not really sure if that'll negatively impact them. I didn't see a whole lot of that in my experience.
I'm going to punt to Julie.
Well, I have firsthand experience with this because
Okay.
when COVID hit, I put my properties in forbearance just to protect myself because I didn't
Yeah.
know how long this was going to go on. Within 60 days, I went back and I said, I don't need this. So I went and paid it. When I went to go and take out the next loan that I was buying a property, it was a multifamily property in Tyler, Texas, 107 units. They saw that. And
Oh, wow.
while they told us, hey, there's no problem with this, it did show up, and it showed up with more of a concern. And I had to go back several times. No, this was just to protect me. I didn't know how long it was going to be. So I think on the front, on the face of it, they said, no, it's not going to be a problem. But I do think that it does have a little bit, it rubs a little bit of a stain on you.
Yeah. That's what I've heard from other operators as well. I didn't have that. I didn't go in forbearance on any of them. So I can't say personally, but I've heard others say the same thing. It's like something they tell you, oh no, it's fine. But yeah, it definitely comes back around on the report.
Yeah.
Wow. Yeah. Didn't know that.
Hey, Justin, I had some questions. My name's Tucker Rainey. I'm with Greenbrier Capital Group, and I wanted to hear more. I wanted to hear more about the property that you closed on recently. I think it was a few months ago you mentioned.
Yeah, correct. Property in Jacksonville, North Carolina. Jacksonville is, really stable, affordable area. It's really near a lot of major employers, and we like the area. It's an on-market deal from Cushman & Wakefield. Went through a couple of different rounds, best and final, and we were awarded the deal. Bridge loan, actually. So it's only been operating for about 2 months, but we're getting in the middle of the business strategy, performing renovations, things like that. Yeah.
What was what's the scope of the rehab that you're planning, and were you able to finance 100% of that with the bridge loan, or I guess
75%.
I don't know if bridge loans were that hot a few months ago like they are now, but I've had a lot of quotes recently that look really good when you can finance all the CapEx.
Yeah, correct. All the CapEx was included in the loan. So we're planning on interior renovations around $5,000 a door, bringing online an empty room that we're turning into a laundry facility. And the property had absolutely no amenities. And so as you can imagine, with a large property like that, it could definitely benefit from some amenities and making the lives of the tenants better. So we're adding a dog park and a little grill area, and I believe there's a couple roofs that we're replacing also.
Gotcha. How did you find a property manager? Or I'm assuming you're using a property manager, but do you have a relationship down there already? Or did you interview a handful of them?
Some of my partners had the relationship with them. There's actually a sister property a couple miles down the street from the one we bought, and I mean almost really similar property that had already gone through a similar value add strategy of getting stabilized, performing renovations and things like that. And so we're pretty much just copying that strategy, underwriting to those pro forma rents. So we felt like we already had a pretty proven value add strategy, and we're using the same property management company that did the strategy on that one on ours.
Gotcha. Great.
On the bridge loan that you're using, are the renovations done on a draw program? Like, are you paying up front and then submitting to get your money back?
It'll be done on a draw system. Yeah.
Gotcha.
Exactly.
Gotcha. Anybody else have any questions? Going once, going twice. I was at an auction over at a charity event over the weekend. I feel like I want to become an auctioneer now. I don't think I can move that fast. Once going. But well, great, Justin. Thank you so much for coming on and sharing some of your experience at underwriting and sharing your new deal with us and some of what's going on with that. That was really informative. I think helpful for a lot of the folks that especially don't have a bridge loan experience and understand that as an option. So really cool. Thank you for sharing with that.
Thanks for having me.
Yeah. So as we move into phase two, I give this plug every time, but you guys only get out of it what you put in. So, I ask for people to share and let us know what your need, what you're working on, what your needs are, what your haves are. If you have other things to share, I have a pretty interesting one. So I'll start out this time around. And so for you that don't know me, my name is Kent Ritter. I host the Meetup here every month, second Wednesday of the month at 6:00. And I am actually transitioning a little bit. I recently left a role at the firm here in Indy called Birge and Held to pursue deals on my own under my own banner. So I'm striking out on my own to pursue syndications. I'm very excited about it. It's about a week old, so it's hot off the presses, but really excited to be out and just have the flexibility to pursue the deals that I want with the partners that I want, and looking forward to the future here. And as I do that, I've had a little bit, and Julie, since you're on, this is the one that I talked with you about. I was actually gonna give you an update on this, but we've had some interesting conversations with our seller. So I was in a position where had a property, had the LOI signed, had contract in the seller's hand. And this is why you should never say it's under contract until it's really under contract, because what happened was the Biden came out with their announcement a couple Fridays ago on what tax increases may look like, right? And things still have to go through Congress. There's going to be a lot of changes between now and what it finally looks like. But one of the things he said was they are looking to go retroactively, maybe back to April of this year, and they are looking to, and some maybe even get up to doubling your capital gains taxes almost in some instances. So we don't know exactly where it's going to land, but retro is on the table, right? Which means deals this year could be affected, and also capital gains are going to see some sort of increase, I imagine. The reason I say that is because my seller, who is very much a kind of mom and pop guy, it's the only multifamily he's ever owned. He literally lives right behind it. Heard this and just got spooked and decided that he's not doing the deal, but he's also just not doing anything right now. And he's kind of saying, I need more information. So my job and what I'm really trying to push on the broker's job is to get him back to the table. So I've been thinking about creative financing options. Now, I've not done any creative financing in my career. I've been very vanilla, down the fairway, agency debt. So, but a couple things that we talked about, which I'm wondering if anybody knows and has any insights on, would be doing an installment purchase where you're paying over time, doing some sort of seller financing. We even talked about like a master lease option, all different scenarios. And so if anybody's got any insights, I'd love to hear them, because my next meeting with this guy, I'm going to put down several options in front of him and try to figure out how we can get this deal done.
I would tell you that we've seen recently where the seller doesn't want to necessarily get out of the deal. He stays in the deal as an LP.
Mm-hmm.
And he uses the cost segregation part of that. Now I've had some sponsors say, you can stay in it, but you're not taking advantage of the cost seg on it. And gives the real LPs their benefit, the benefit that he would get for them. So that is becoming more and more popular, actually.
That's one that we have talked about too. And for me personally, I don't really need the depreciation from the cost seg. So I'd be even willing to tell the guy, like, I'll give him the majority of the cost seg. I think that's a really, really good option. I think his initial response, he's very much a hands-on guy, and to have to like kind of give up ownership, he's like, well, why don't I just keep running it myself then? Because he's running it at like a 30% expense ratio, because he lives behind the thing and manages it himself. So I think that is going to be one of the things I present. I think the thing I'll have to get over is his control, his want of control.
Yeah, that's not going to be an easy one.
No.
It may be something that you just need to separate him from the transaction itself.
Yeah, that's why I was thinking an installment purchase might be a really good option. I don't know much about him. I mean, I've Googled IRS website, but essentially what I know about him is they're set up to spread capital gains over multiple years. That's why they exist. This is essentially what this guy wants to do, is not hit that $1 million threshold in a year, because that's going to kick him up into where the brackets really start to escalate. So my thought is, if we could do that and just pay him out over several years, it might meet the needs. I don't know much about him at this point. So I don't know, anybody out there know much about installment purchases? Anybody ever done one? No, it's all right. I'm finding some attorneys that can teach me about them and how the mechanics work. But yeah, it's an interesting situation to be in. I feel like we run into this. So we've been in a market where in like the last 10 years, all we've heard is good news about capital gains and everything else. And so now going the other direction, I feel like we're going to have these creative situations that we need to figure out ways to work through.
I think that seller financing option is good if he agrees to it, because you can almost give him a suitable down payment that's going to be under that, $1 million mark. So he's not in that higher tax bracket, and then essentially spread out the rest of the capital gains over, each year with payments. I mean, if he's on board with that, usually it's pretty advantageous for you too, if you can get, a good rate or whatnot, and then kind of present to him. A lot of times what I've heard, a guy, he always does seller financing on mobile home parks, and it's always like mom and pop owners. And he's like, all right, well, if you're going to sell and you're just gonna have this lump sum of money left over, well, you're gonna have to pay taxes on it, and it's gonna sit in the bank at like 2% interest rate or something like that. Well, how about, I pay you a credible amount of down payment, so that you're happy and then you get some cash in your pocket. But instead of making 2% from it sitting in the bank, I can give you, 4% or whatever it may be as seller financing. And
Yeah.
it's usually if you can just explain it to them, he was saying, and then like write it down, they're like jumping all over it.
Hmm.
But
Yeah.
usually if you just straight up are like, hey, you want to be the bank, they're not as excited
Yeah.
about it because they just want their money. They want
Yeah. If you
out.
can show them the cash flow stream, maybe.
Exactly.
And I think seller financing could be a good option. The issue is he has a current loan. And so he's got a mortgage. So I know we were getting the paperwork on the mortgage because there's typically, I mean, I'm sure there is a due on sale clause. So meaning that the mortgage is going to be called due if we do sell it. So I think, I don't know the exact mortgage amount. It's something, a little bit north of $1 million. So it's like, okay, could we pay that off with a down payment, right? He could go and pay that off. We could seller finance the rest, perhaps. And I don't know what that does to like the LTV, but that was about what we were going to raise. So we were going to raise about $1.5 million anyway. So I'm like, if we raise that and really instead of the cap going to purchasing CapEx, that goes to really paying off his loan. And then he finances enough to finance the rest and the CapEx and everything else. That could work too, I think.
Might work. Yeah, there's the subject to, I don't know how favorable his current mortgage is, but there's always like a subject to where you can like assume the current mortgage.
Yeah, I guess that would be the other thing. If I could assume his current debt.
What is your play on it? Is it to, put in some CapEx and then significantly increase rents? And I mean, obviously you're probably not going to operate a 30% expense ratio like him. So your expenses will go up a little bit more.
Yeah. I mean, it's a straightforward value add play. I mean, there's significant upside if we can get the deal done. And yeah, it would be probably trending more toward a 5-year hold. But yeah, it's a pretty typical value add. We're going to do interiors and a little bit on the exteriors.
Interesting. Yeah, seems like there's some creative options. Creative financing is coming in here big time.
Yeah, which is good. I mean, it'll be good to learn a little bit more about, but anyway, just curious if anybody had experience. So who else wants to go? What does anybody else have going on? Trying to get a deal, don't know where to start, have a deal, you want to sell it, need financing. There's some people on here that can help you.
Well, I have a tick.
Yeah.
And now with all of this, Biden crap, I'm just curious. I should just cash out. Today's probably much better than waiting 5 years.
Yeah.
And we've got triple the amount of capital gains, but that does not make me feel happy. I was hoping that it was like going from the time that it is in place, moving forward,
right,
not backwards.
Right.
Yeah.
Well, they are saying, I mean, the thought is, at least from what I've read, is that might be one of the first things to be negotiated is to not go retro and just start 2020 or 2022 forward. So that may be one of the most contentious points that gets struck to get the rest of the deal through. So it's just so hard to say at this point. I have a friend he's in a 1031. This is the other thing I want to tell you. I have a friend who's in a 1031 right now, and he needs to identify in the next 39 days. And he's got 2.3 million that he wants to place. And yeah, he's thinking about the same thing of like, do you just take the hit now instead of instead of waiting the 5 years and then potentially taking the hit. So yeah, it's a big consideration.
Does he need, I mean, I've got, I think 7 days left on mine. So,
Yeah.
I don't know if he wants to shop it, but I'm going to be doing a tick into a syndication, which can be challenging. I did another one earlier
Yeah.
this year.
Yeah.
And we were able to get it done. We did it on a small balance, Freddie,
Mhm.
and they said no more. The next day they changed the guidelines. So, you know, that product was structured to be kind of from a bank. Okay, we want non-recourse, so let's go to Freddie. That's kind of Freddie SBL that's the product.
Mhm.
And so we were trying to use kind of some higher thinking type of financing, you know, and apply it to that Freddie. So no more, but this is a Freddie floater. So we're just waiting to find out. I mean, it's 2.7 equity multiple, 5-year hold. So I don't know if they're interested. I'm happy to, you know, push his name along, you know, to you to, you know, contact me. I can have him contact the guy I'm working with.
Yeah.
It's
Yeah,
a
for sure.
$6.5 million raise.
Oh, gotcha. Okay. Yeah. I mean, I'll shoot you an email and get you
Okay.
guys connected. Cause yeah, I mean, I don't think he has anything yet. He's looking.
Okay. They're hard to find because a lot
Yeah.
of people say can't do it.
Right.
But
Yeah. I haven't, I've heard of people saying that they have, you know, rolled a 1031 into a syndication, but I've never actually heard how they've made that happen. But it'd be interesting to hear about.
So I did, you know, I do the Zoom at 8 and we did a whole, we went from start to finish on it. And you guys are welcome to go look at it.
Oh, cool.
It's under Julianne Peterson. So if you want to have your guy look at that, how we structured it, I had my attorney on, I had the syndicator on, I had the insurance guy, just talking about our deal and how you structure it. So
Oh,
that'd be
cool.
helpful.
Yeah, definitely have to check that out. That'd be
Yeah.
interesting just to learn.
Mm-hmm.
Well, awesome. So are you thinking at this point, you said you have 7 days
I think
left
so,
to
yeah.
identify?
Yeah, so I'm definitely going towards this one
Yeah.
deal in
Yeah.
Fort Worth.
Yeah.
We're just waiting to hear back from Freddie Floater. It's a Freddie Floater
Yeah.
to see if they'll allow it, because from a small balance loan, you had to have net worth and liquidity on your own as the
Yeah.
tick, yeah. And I was like, no,
Oh,
no.
okay. So if it's
Yeah.
tenant in common, it's not spread across the GP because you guys are all independent. Gotcha.
That's correct. But I think Fannie does it that way where you don't have to stand alone. It's, you know, a conglomeration. But
Yeah.
Freddie was saying, hey, if the GP takes off, you're in charge.
Yeah.
You don't have the net worth and liquidity that you need to have. So
Interesting.
that's what we're
Interesting.
just trying to put make sure that we can do that. So,
I gotcha.
mm-hmm.
Very interesting.
Yeah, so I'm sure they would be happy to take a look at the larger, you know, to have him do a tech.
Yeah.
We'll just use our same attorney.
Right on. Cool. Anybody else out there? How about Tucker? What are you working on, man?
Yeah, sure. I'll kind of tell you my quick story, I guess, and then tell you what I have going on right now. So I started investing in real estate about the beginning of the pandemic because I guess I had a lot of time on my hands. I'm a structural engineer by trade. I still work full time as a structural engineer. But you know, I read a ton of books last year and started getting into real estate. I teamed up with a couple other people and bought 3 different triplexes in New Hampshire. And then one of the guys convinced me to dream bigger. So we started, well, he'd already been involved in syndications before that. And so I started underwriting larger units, larger properties. And right now we're involved in 214 units or so. So we're kind of at the point where we have a pretty good network, but it needs to grow if we want to continue growing. So I'm starting to attend more events like this to meet people to team up with and help us, I guess, find more deals and raise more money. It's kind of the name of the game, I guess. But
Awesome. Well, congrats, 200 something units in the last year. That's great.
yeah, thank you. I'm hoping to keep it going for a couple more years, and maybe I don't have to work this full-time job still.
Was that one deal or multiple deals?
Multiple. So we've been involved in, well, in total, including the triplexes, I've been involved in 5 deals. So I guess, yeah, two big ones.
Gotcha.
Yeah.
And you syndicated both of those?
One's a JV, but
Gotcha.
the other one, yeah. So
very cool.
Yeah, pretty exciting. But
yeah, you're off to the races.
I'm drinking the Kool-Aid, so I'm gonna keep doing it. And you know, we're part of a mastermind, like a paid mastermind. So we've got a pretty good network of high net worth people, but it needs to be bigger so that we can find more KPs and people to go on the loan with us.
Yeah. Which mastermind are you a part of?
So it was originally with Kahuna Investments. They're out of Arizona, but it actually just got lumped into Investor Fuel is what it's called.
Okay.
So they're kind of merging the two together right now. I haven't actually been to an event since they started the merger, but
nice. I haven't heard of that one. I'll check it out.
Yeah. I think it's you know, it's smaller than, like, was it the Rod Cleef's big one or any of the big ones that you hear about? It's pretty small.
Yeah. Gotcha.
Yeah.
Well, very good.
Yeah.
And you're looking in the Southeast, Tucker?
Yeah. So I've underwritten properties, I guess, everywhere, but we're primarily focused on like Georgia and the Carolinas, and we've looked at some in Florida and Virginia. I don't think we can really compete in Texas, so we're kind of staying out of there. But we've also underwritten some properties in Oklahoma because we have some partners in that area. So we're kind of everywhere in the Sun Belt, but mostly focused on Georgia and the Carolinas. Yeah.
Awesome.
Though Indianapolis, I'm located in Chicago.
Okay.
So I kind of thought to see what Indianapolis meetups there are. But Indianapolis seems like there's some opportunity there as well. So I've been thinking about starting to take a closer look in that market.
Where in Chicago are you from?
I live in Old Town, but I'm actually from Central Vermont. But I've lived out here in Chicago for 8 years, 9 years, something like that. Yeah.
I spent 12 years in the city, and the last 5 were in Old Town.
Oh yeah.
Yeah, right by the Cedric Brown line.
Yeah, I'm not far from there. I'm 5-minute walk from there.
We're on the Brown line too in Southport.
Oh yeah.
Yeah.
Great.
We had a multifamily there. Yeah. Mm-hmm.
Yeah, I love it. I was in the Old Town Triangle for a few years, and then I moved just south of North Avenue now a few years ago.
Nice.
So are you a Cubs fan or are you White Sox? Come on.
Cubs, I guess. But originally from New England, so the other Sox.
Julie, you can't tell me that you had a property up on the Brown line in Southport and that you were not a Cubs fan. You could throw a rock and hit the stadium.
Yeah. Oh yeah, we could walk. We had our own parking, so we were all set.
Yeah.
It was a great place, but gosh, I mean, talk
so
about
different now. It's crazy. It's so much different.
Appreciation in Chicago.
Yeah, pretty much flat.
But I'm in San Diego, so you know we wait a couple of years after you make $3 a month in cash flow, and you walk away with a lot of money, but, and all along for those 2 years, you're biting your nails. So yeah.
Awesome. Well, thanks, Tucker, for sharing.
Yeah.
Anybody else want to
That's-
share?
I'll share.
Yeah, please do.
Hey everyone. So I'm actually in Indianapolis, but brand new to multifamily syndication. So I'm an engineer as well, a mechanical engineer. And what I did was I partnered with a friend and we bought 2 duplexes a couple years ago. And so started small and kind of super hands-on, try to do everything ourselves. And then something from Justin's presentation that kind of was the reason why I hopped on this meeting was the scalability of it. It's just, you got to think a little bit bigger. It was taking up a lot of my time in terms of like doing the maintenance and like managing the tenants and stuff. I mean, it kept my costs down, but in terms of scalability, it wasn't there. So trying to look a little bit bigger, get involved in some of these meetups and kind of see what's out there. So I'm super new to it, but interested in learning more, and then interested in kind of building a team and maybe understanding maybe your guys' teams and how they function. I mean, Tucker had mentioned that he just recently got into it like a year ago, and he already has some experience under his belt. So he was obviously able to kind of build a team quickly and kind of get some deals under his belt. So I'm kind of trying to do the same thing, maybe a couple steps behind, but that's why I'm here.
What I did to build my team was just tell everyone what I'm doing. Everyone that you talk to, just be super annoying and tell them all that, like, yeah, I'm trying to do this real estate thing. And then it turned out that I met, well, one of my old high school friends is the guy that I'm now partnering with and part of this company with. I didn't know that he was doing this at all. It turns out he was. So I got kind of lucky with that. But yeah, that's what I would suggest. Just tell everyone. And some people will perk up and be like, oh, I've thought about doing that. Or I know someone that does that. And go from there.
I would be all over social media.
Okay.
Just get on, meet up people, talk, connect.
Yeah,
really
there's
important.
There's some really good Facebook groups I mean, there's some huge ones and there's some smaller ones. Justin has one actually. And but those are great places to start, just seeing what people are talking about, meeting people. And then these meetups are awesome to get a little more face to face.
Yeah.
You won't want to miss the Old Capital podcast as well. It's been around for like one of the top ones for a really long time, and it's not fluff and sales. It's really an education platform, and people love it. So take a look at that.
I will.
Yeah.
I'll just kind of echo what everybody else said already. But yeah, I mean, having a thought leadership platform has just been a game changer to me. So like I mentioned, like in my presentation, but just staying top of mind to people has just been extremely important. And like if you were to come across a deal and maybe you talk to an investor or a partner one day, and then 6 months down the road you've never followed up with them, you've never posted on social media, and you call them 6 months later like, hey, I got a deal, let's partner on this. I mean, they're going to be like who are you again? I mean,
right.
So I mean, just staying top of mind to everybody. Like on my LinkedIn, I have investors, other operators, tons of brokers. So I mean, they see my posts on LinkedIn every day. They see that I'm out here, working towards my goals, being consistent. So that's been a game changer. And one more thing I would add is just, I mean, partners are everywhere. You never know where you're going to meet your next partner. It could be here in a meetup group, it could be on LinkedIn, Bigger Pockets. When you take somebody out to lunch. So just constantly hopping on calls, networking, taking people out to lunch. And more experienced partners are, more than willing to, partner with you on a deal if you bring them a deal and add value to them in some way. So one way to kind of get your foot in the door is just to find somebody more experienced, somebody that's, actively syndicating and doing what you want to do, and, find a way to add value to their business or them.
Okay. Yeah, we'll do. And I guess kind of on that note, I know some of you said you're not located in Indianapolis, but still join the meetups. I guess I'll throw it out there just so I can start making some connections. But I am in Indianapolis, and so if anyone needs boots on the ground, I can be your guy in any way. If something needs to get done or something, or just check something out, take some pictures or something, just throwing it out there. Thought I'd make some connections.
Yeah, no, that's great, Michael. And I am in Indy. Well, technically, I'm up in Westfield. I'd be happy to grab a coffee or a beer or something with you, man, and just connect and help you out as we can. I'll throw really for everybody. I'll throw my email in the chat, and you can just reach out to me. Happy to meet up or talk with anybody. I love chatting real estate.
Awesome. Sweet. Yeah, I appreciate the info.
Definitely.
And you live in Indy, Michael?
Yep, I'm downtown.
Okay. I was going to mention, Friday, I'm going to Topgolf at like around 6:30 at night. I'm meeting some other, real estate investors there. If you wanted to join, come on along. It'd be great.
I would. If it was any other weekend, I'm from Columbus, Ohio originally. So I'm actually heading there for my friend's wedding. So this weekend doesn't work, but I have
another time.
So I have Ken's contact information. We can, and I just signed up for your email, your 7-day information stuff. So I just subscribe. So yeah, I'll be sure to reach out.
Perfect. Well, how about the Scots? Hello, Scots.
Hi.
Okay. How you guys doing?
Good. How are you doing?
Doing very well.
Yeah. Thank you guys so much for this. This is the most live meetup that we've been to. And so we're actually located in Oak Park in Illinois.
Yeah.
So I just recently got my real estate license. And Indiana has kind of like a reciprocity. And so I've been kind of looking more into like, what's going on there? And so that's why it really kind of piqued my interest to look in Indianapolis. And so we're definitely very new to this. I work in chemistry. He works in finance. It's my husband, Chad. And
hey, Chad.
You guys.
Yeah. So, we're definitely new to, we just bought our first home. And then ever since then, we've been really thinking real estate. And so, just looking for ways to connect with people and, got my real estate license, just kind of wanting to get into the game a little bit and to see what connections I can make out there. So
what are your guys' goals?
Yeah, definitely.
As far as investing.
Yeah, definitely wanted to do commercial. That was a thing. And definitely starting out with multifamily, and obviously multifamily is very scalable and amazing. So might even just stick there. But so that's pretty much, throughout our research, it's been like something that makes a lot of sense. It's about the numbers. And so that's kind of like where we're going towards.
Yeah. So my wife is being pretty modest, but she's she spent a lot of time doing a lot of research, going to a lot of classes. She's pretty good at like the analysis piece. So she got the real estate license to get access to the MLS. She has was in this program, so she has like an analytical tool. So she's good at the underwriting stuff. So looking for people to connect with, to do deals on, and then do deals with, and then to share like things if she were to find something on the MLS, somebody who could partner to carry the deal through. Of course, we don't have any experience, so but got knowledge and hustle. So yeah.
Awesome.
Can I recommend something for everybody? There are lots of ways and places to pay a lot of money to get into an education program, and number one is educating yourself and relationships. I work with a guy, Jim Biggs, who started a thing called the GOB Network. You should look it up. It is a free training program where if you want to go learn how to underwrite, if you want to learn how to capital raise, if you want to learn how to be a property manager, all the different aspects you can learn through this group. There's no charge. All they ask is that you bring something. Like if you're really good at underwriting, then you teach others how to underwrite. Or, if you're good at capital raising, show others how to do it. So check that out, gobnetwork.com. Tell them Julie. I partner up with him on a lot of these deals. Jim Biggs, he also has a meetup in Chicagoland on Sundays. So take a look at that too. He's a great guy.
Yeah. Jim's
And
a
everybody
super
else
nice
too.
guy.
Everybody else is always welcome. It doesn't mean you have to be in Chicago. So.
That's awesome. Thank you.
And by
Thanks,
the way,
Julie.
I was born at Oak Park Hospital.
Nice.
My claim to fame.
Yeah.
Well, awesome. Well, there's some great resources for you guys. And yeah, Jim is a super nice guy. So he would be a good resource. So awesome. Who else? Who else wants to go?
Okay, I have one more thing and then I'll jump off of here. One of the big things that you need to understand is what your market is, where you want to go. And I think that there's a key boot camp that is available through Neil Bawa, B-A-W-A, Nealbawa. It's $2,000. And he takes you through, you don't have to pay for any services. It's everything can be found on the internet. And it's a boot camp that's over the weekend. In the past, it's been face-to-face, but I think it's now virtual. But people that have been doing business for 13, 14 years, they still take it. So I really, of the two things that I highly recommend, one is this Neil Bawa's group. So check that out.
Awesome. Very cool. Thank you, Julie. Appreciate you sharing that. Okay, who else wants to chat? Sean, how about you, man?
Oh yeah, I was volunteering. Absolutely. What's going on? How y'all doing?
Doing well.
First and foremost, Justin and Ken, appreciate y'all for sharing and hosting this evening. Based out of Indianapolis as well. So Justin, if that invite is open, I'll definitely get topped off at 6:30.
Yeah, come on down.
I'll be there. I'll bring my partner too. So I'm going the owner financing route. I have a mentor. He's in the process of launching a bank right now, so he really can't be like hands-on in the process with my partners and I. So we're going to go the owner financing route until he gets everything situated, and then we're going to partner with him to take down deals for JV opportunities. So right now, we're looking at Indiana, Georgia, the Atlanta Metroland area, and also Austin, Texas. So we have somebody that's down there. So it's like 5 of us in a group that was created by our mentor last year on this launching the bank. So we're learning. We submitted a few LOIs. We submitted an LOI for a property in Houston, got outbid for that. So that was a learning experience. But yeah, that's where we're at. Submitted 3 LOIs so far. Yeah, like I said, just learning everything, learning different ways of getting our first deal done as a group. So
awesome.
And I have a wholesaling background as well. So.
Gotcha. Congrats. Sounds like you're moving into the ownership side of things. So that's fantastic.
Absolutely. That's how you create the wealth. Yes, sir. Yes, sir.
That is right. How about Christine, you want to share what you're up to? Oh, I think you're on mute.
Whoops, sorry about that.
No worries.
Good, thanks. I actually just joined the group like 5 minutes ago. It popped up and I was like, oh, I need to. So I'm trying to get more active in the multifamily area. So I'm in Indianapolis. I am a realtor. I currently flip houses with my husband. And I've had rentals in the past in other areas in Indiana, but do not own any rentals now. So we've just been focused on basically flipping and getting our capital together. So we're in a good position now. We also have a private lender as well. So we're ready to move on the multifamily front. I've also done some wholesaling here in Indy, not on multifamily, but on single family. So I'm pretty familiar with like direct to seller stuff. And as a realtor, I've sold commercial multifamily properties. In terms of like record, not sold, actually worked with buyers on them. So I'm super familiar with all the due diligence and stuff. So now it's just finding the deals. That's where I'm at.
Very cool. So you guys sounds like you have all the pieces together. Where are you looking for deals?
I actually am super comfortable with the Indianapolis market. So I'd like to be in the either in the metro area, but I'm actually fine to go like outside, but I am looking to stick to Indiana on this first one.
Gotcha. Yeah, nothing wrong with going in your backyard. And do you have good broker relationships? I know
yeah, so that's honestly, that's what I need to work on. So my relationships haven't really been in the multifamily realm. So I think getting in with a lot of the commercial brokers that I really haven't worked with before. So just getting in front of those brokers, and then honestly, like, I think I'm lucky I have a lot of like realtor tools, so I can get in there and get to owners of multifamilies and stuff like that. So really, my husband and I just sat down today talking about like, how are we going to generate leads? Like, how are we going to attack this? So I'd love to get seller financing, but we have some money for that. So yeah, anywhere from like I'd like to start like in a 10 to 20 unit would be ideal.
Yeah, awesome.
And then because we flip, we've got the contractors and stuff lined up. So I think we can just, migrate our guys over to that. So yeah, so I'm excited, but I need inventory. I need a deal.
That's what it's all about. You got to make those relationships.
Yes, exactly.
Absolutely.
So I'm here to learn.
Very cool. Awesome. Well, good to have you here.
Thank you.
About Ruby or Lorenzo, you guys want to share? I will take that as a no. Right on. Well, thank you guys so much for coming and spending an hour and a half with us tonight. I know everybody's time is valuable, but hopefully you got some value out of this. Check out the chat. It was fairly active this month, and so I put my email out there. I'll put it again at the bottom so y'all can reach out to me if you have any questions. I mean, really, just here to help. Love helping people get started. And I personally think it's the best thing you can do to build wealth for you and your family. So definitely you can't go wrong. And with that, yeah, we'll sign off. But thank you guys so much for coming. Thank you, Justin, for your presentation, walking us through those different things. It's really insightful to learn more about bridge loans. And thank you for everybody that shared. I mean, that's really what it comes down to. It's all about networking, and everybody's talking about, like the common thing I heard was like, people need relationships. They need somebody, they need to know people. I mean, this is how you do it. So you never know when somebody's going to connect you to the right person. So thank you all. And hopefully I'll see you next month.
Thanks, everyone.
Bye, everybody.
Thanks, Justin.
All right, y'all have a great one.